Hello student, today I am going to teach about the valuation of goodwill. Last video I told you about the characteristics need for valuation of goodwill. So let me explain the method of valuation of goodwill. And before explaining the methods of valuation of goodwill, I want to say two sentences about the valuation of goodwill. Means it is an intangible assets. Why we are saying intangible assets? Means goodwill we cannot see, but the benefit we can realize. Benefit it is generally comes to the business. So it is an intangible assets. So as it is an intangible assets, we cannot calculate the accurate value of the goodwill. And last video I told you goodwill is calculated on the assumptions of the valuer. How the valuer he is calculating the goodwill, on which angle he is going to calculate it. So there are three methods. And it is not sure that the goodwill calculated in one method may or may not be same the value of goodwill calculated in another method. Clear? So the methods of valuation of goodwill, first one is average profit method. Average profit method. Clear? First, let me explain first average profit. Average profit means how we will calculate the average profit. If a number of years it is given, first of all we will calculate the total profit and it will be divided by number of years. So that is average profit method. Another is super profit method. And third one is capitalization method. Let me explain each method separately now. Capitalization method. So under the average profit method, clear? What is the formula for calculation of goodwill? Goodwill equal to average profit into number of purchase year. Average profit into number of purchase year. So whenever question it will be given to you, or the question it will be asked to calculate the value of goodwill on the basis of average profit method. So two things, that means you have to find it out from the question. First of all, average profit. So first step you will calculate the average profit. How will calculate the average profit? Suppose 4 years profit it is given. So average profit. So all the profit of 4 years it will be added and it will be divided by 4. So average profit equal to total profit of the years. Total profit of the years divided by number of years. That is known as average profit. And it is also, that means seen that, and means one assumptions we can say that when a new business it will establish, it may not be able to earn the profit during the first few years. So goodwill is calculated on the basis of purchase year. What is purchase year? Up to how many years the same profit it can be earned. Suppose that means the average profit of a business it is given 30,000. Average profit of a business it is given 30,000. So this 30,000, for how many years this 30,000 profit it can be earned from the business, that is known as average profit, average number of purchase year. So number of purchase year, it is no need to calculate, it will be given in the question. But you have to calculate the average profit first. Average profit, how you will calculate? Total profit of the years divided by number of years. Suppose that means 4 years profit it is given. Out of the 4 years profit, that means it is given. Suppose abnormal profit, abnormal loss also it is given. So whenever you will calculate the average profit, by that time you may get the treatment about the abnormal profit and abnormal loss. Abnormal profit and abnormal loss. Abnormal means this profit is not related to the business, and we generally calculate goodwill on the basis of the firm's profit. So whenever the profit it will include the abnormal profit, we have to deduct it. Abnormal profit, clear? Which generally, that means sometimes it happens. Suppose in a specific year the firm sold the old machine, and through the selling, that means firm earned a gain of rupees 20,000. This is abnormal profit. Similarly, abnormal loss. If in the question it will given abnormal loss, we have to add it. Abnormal profit, you will remember one thing, you have to minus it, and abnormal loss we have to plus it. Abnormal loss, if it will be given in the question, that means we have to plus it. Clear? These are not related to the business, but that means this treatment already happened in the business. So we have to first do the treatment of abnormal profit and abnormal loss if it is given in the question. So whenever you will solve the average profit, that means calculate the average profit, by that time you will see if the question contains about the abnormal profit and abnormal loss, first of all you will calculate the profit after either deducting or adding. Clear? If abnormal profit it is given, you have to deduct it. If abnormal loss it is given, you have to plus it. Then you will calculate the average profit. After calculating the average profit, how will you calculate the goodwill? Average profit into number of purchase year. It will be given in the questions. Like this information it will be given. Calculate goodwill on the basis of average profit of the last 4 years. Average profit of the last 4 years into the number of purchase year it will be given. Clear? So according to the question you will do it. So number of purchase year, that means you should not think that we have to calculate the number of purchase year, it will be given in the question. Another thing, under the average profit method, sometimes you may get questions about the weightage average method. Whenever that means weightage average method, if the question gives you about the weightage average method, so by that time you have to multiply the profit with the weightage it will be given. Clear? Suppose in a specific question, suppose it is given 2018, 2019, 2020, 2021. For example, I am giving one example. Suppose 4 years profit it is given. Suppose here, that means 2018 profit it is 40,000. Clear? And suppose 2019 it is 30,000. Suppose it will be given 45,000. Suppose it is given 50,000. These are all I am taking the assumptions value. And suppose weightage it is given. Weightage 1, 2, 3, 4 weightage. So whenever weightage it will be given, you have to multiply the profit with the weightage. So 40,000 into 1, it will be 40,000. Clear? Similarly, 30,000 into 2, it will be 60,000. 45,000 into 3, you will write it will be 1,35,000. And 50,000 into 4, it will be 2 lakh. So after multiplying, you have to add it. You will add it. It will be, that means it is 5, then 4,35,000. Clear? So then here you will calculate last, that means before that I told you average profit you will calculate by, you will divide the number of years. But here it is, suppose number of years 1, 2, 3, 4. You will not divide by the number of years 4 years. Weightage it is given. Whenever weightage it will be given, you have to add the weightage also. Weightage is 10. Clear? So you will write here weightage average profit. Weightage average profit. weightage average profit, weightage average profit. Suppose here you will calculate 4,35,000 divided by 10. So it will be 43,500. After that, this value will multiply with the number of purchaser. It will be given in the questions. So goodwill equal to, you can write goodwill equal to weighted average profit into number of purchaser. Weightage average profit, weightage average profit into number of purchaser. So that means generally this type of treatment you will get under the, that means average profit method. Now that means more questions, that means more treatment I will say whenever I will solve the questions individually. I will solve the question under the specific method. Some individual questions I will do you separate treatment. Sometimes that means I will show the solution how to treat the capital nature. Sometimes it is capital nature, it should be treated, but by mistake it is treated revenue nature. So sometimes opening stock, that means or closing stock of last year, it is overvalued or undervalued, and the treatment of, that means management cost, all the things, that means I will say you in one questions. So first let me give the explanation of each and every method first. So first method I already told you, that is average profit method. Now I am going to explain about the super profit method, that is super profit method. Super profit method. Super profit method. First of all, means what is super profit? Super profit means I will calculate super profit. Super profit equal to average profit minus normal profit. Average profit minus normal profit. Clear? These two profit you have to, that means suppose average profit is also given for number of, that means 2-3 years profit it is given, from there you will calculate average profit. Normal profit you generally have to calculate it. Clear? How will calculate the normal profit? Normal profit equal to normal profit. These are the step. First you will calculate the average profit. If it will be direct value, it will not be given. First you will calculate the average profit according to the information of the questions. How will do it? Means suppose number of years it is given, 4-5 years profit it is given. So you will add it and you will divide it. So that will be the first step for calculating the average profit. After calculating average profit, then you will calculate the normal profit. What is the formula of normal profit? Capital employed or capital invested in the business. Capital employed or capital invested into normal rate of return by 100. Normal rate of return. Normal rate of return. Normal rate of return by 100. Clear? What is normal rate of return? Generally, how much amount of return it can be, that means received from the business, or it can be done from the business. That is normal rate of return. It will be given in the question. Clear? So what is capital employed? Just now I told you that capital employed means the total capital invested in the business. So capital employed equal to capital employed. Capital employed equal to total assets minus external liabilities or outsiders liabilities. External liabilities. Clear? Total assets minus external liabilities. Whenever you will calculate the total asset, you should remember that means suppose existing goodwill it is given in the question. So existing goodwill means you have to exclude it, and suppose some information it will be given about the fictitious assets, that also you have to exclude it. Clear? Means we can say total asset. How will calculate it? Excluding goodwill means existing goodwill. Suppose goodwill it is already calculated, goodwill already it is given. It is given already. That you have to exclude it. And fictitious asset you have to, that means exclude it. Then external liabilities. Then you will get the capital employed. After getting capital employed, normal rate of return it will be given in the question. So you will get the normal profit. So super profit, how will get it? The difference between the average profit and normal profit will be the super profit. So these are the steps. Again I am going to explain it. First step, you will calculate the average profit. Average profit you will calculate. Suppose if it is calculated value it is given, no need to calculate it. If 2-3 years profit it is given, you will calculate the first average profit by adding the total profit and you will divide by the number of years. Then you will calculate the normal profit. Before calculating the normal profit, what you will do? You have to calculate the capital employed. How will calculate the capital employed? Capital employed or capital invested in the business. How will calculate? Total assets minus external liabilities. Sometimes in the question direct value it will given the total capital invested in the business is this. So by that time no need to, that means no information about the asset or liability it will be given. So that will be the capital employed. Capital employed into normal rate of return. It may be 10%, 15%, whatever it may be, it will be provided in the question. Accordingly, then you will calculate the normal profit. After getting these two values, you will get the super profit. Super profit equal to the difference between the average profit and normal profit. After finding this, then you can, that means, put the formula. What will be the formula of the, that means goodwill under the super profit method? So goodwill equal to super profit into number of purchase year. Super profit into number of purchase year. Number of purchase year. Clear? Number of purchase year. Super profit into number of purchase year. Clear? Let me explain, that means a small example I am taking, that means explaining. Suppose that means the profit of the last 4 years it is given. Suppose it is given 2016 profit it is given, suppose it is 10,000. Clear? And 2000 suppose 17 profit it is given, suppose it is 15,000. 2018 it is given, suppose it is 20,000. Clear? Suppose in 2019 it is given, that means loss 5,000. Loss 5,000. Clear? So whenever they are first from this information, first I will calculate the average profit. In the question, suppose it will given the capital invested in the business is, suppose here it will given the total capital or capital invested in the business is. These are the information. Capital invested in the business. Capital invested in the business is, suppose here it will be given 1 lakh. 1 lakh. And normal rate of return it will be given. Normal rate of return it is given. Suppose it is given 10%. 10%. Clear? So here, that means from this information we will calculate the, that means average profit. From this information we will get the normal profit. So what will the average profit here? Average profit. How will calculate it? So we have to, that means add it. 10,000 plus 15,000 plus 20,000. Here it is loss. Loss it is given, so we have to minus it 5,000. Divided by number of years 1, 2, 3, 4. So we have to divide it by 4. So what will be the, that means you see now 10, that means it will be 25, 45, 45 minus 5, it will be 40, 40 by 4. So 40,000 divided by 4, it will be 10,000. Clear? So that is average profit. Suppose normal profit I will calculate it. Normal profit. Normal profit. Clear? Achha, let me explain. That means I wrote it here. Normal rate of return is 10%. Let me take it 8%. 8%. Because that means I am giving one example. So whenever you will solve the questions, by that time you will get the correct information. Simply that means an oral question I am explaining. So I change it now 10% to 8%. So normal profit equal to capital employed. What is the capital employed? Here it is given 1 lakh. Capital employed into normal rate of return. Normal rate of return 8 by 100. So it will be how much? 8,000. Clear? Why change it 10% to 8%? Because if I would have taken 10%, so both value it will be same. So there I will not get the super profit. So I change it to 10% to 8%. I change it. Clear? So now what will be the super profit? Super profit equal to, formula you write first. Average profit minus normal profit. Average profit minus normal profit. Minus normal profit. Clear? What is the average profit? Average profit it is 10,000. Normal profit it is given 8,000. It will be 2,000. Super profit is 2,000. After calculating the super profit, then we will calculate the goodwill. Goodwill equal to, will calculate super profit into number of purchasers. Super profit into number of purchaser. Number of purchaser. So we calculated already super profit. Number of purchaser it will be given. There is no hard and fast rule. The number of purchaser it will be always same. It may be different. It may be 2.5. It may be 3. It may be 4. Suppose it is given 4. Suppose let me take the number of purchaser. It is 4. So the goodwill will be how much? 8,000. So this is, that means the process of calculation of goodwill under the super profit method. Now let me explain about the capitalization method. Capitalization. This is that means there are only 3 methods. So all the 3 methods first let me explain. That means you can understand it, and separate question related to each and every method we will solve it. So capitalization method. Capitalization method. Under the capitalization method, you will get 2 things: capitalization of average profit and capitalization of super profit. 2 things you will get it. Capitalization of average profit. Capitalization of average profit. And capitalization of super profit. Capitalization of super profit. So under this method, already it is written capitalization of average profit. So average profit you will calculate, or it may be given in the question. So here, that means under this, the goodwill equal to capitalized value of business. Clear? Or capitalization of, that means average profit means capitalized value of business minus net assets. Capitalized value of business minus net assets. Capitalized value of business minus net assets. Capitalized value means I will get it capitalized value of business. Capitalized value of business. Value of business. It will be calculated on the basis of the average profit. How will calculate? Average profit into average profit into 100 by normal rate of return. This is the formula. Normal rate of return. Normal rate of return means for this much average profit, how much capital is needed to invest. That is the meaning of the capitalized value of the business. To get a specific this average profit, how much capital is needed according to this normal rate of return. Clear? So this is the formula for calculation of that is capitalized value of business. And already I told you net assets. Net asset, how will calculate it? Net assets. Net asset means total assets excluding existing goodwill and fictitious assets. Total assets excluding, we have to exclude, clear? Excluding goodwill. Excluding goodwill. You may confuse about that means about this goodwill. Existing goodwill means already suppose in the question it will be given excluding goodwill and fictitious assets. Excluding goodwill and fictitious assets. Fictitious assets minus external liabilities. So this is another formula. External liabilities. External liabilities. This formula I told when I that means explained about the that means about super profit method. I told clear net assets. So under that means capitalization of average profit, then that means first you will calculate the capitalization of capitalized value of the business. You will calculate it average profit 100 by normal rate of return minus net assets. Then you will deduct. That means you will take the difference. So goodwill equal to capitalized value of business minus net assets. So you will get the good valuation of goodwill under the capitalization of average profit. Then second is here it is capitalization of super profit. So under this method goodwill equal to super profit into super profit into 100 by normal rate of return. 100 by normal rate of return. Normal rate of return. Clear? So that means how will calculate the super profit? Whenever I explained about the super profit method, that means I explained it. How will calculate the super profit? What are the steps for calculation of super profit? So that same process you will adopt here or you will follow here. So after calculating the super profit, then you will write the formula. So you will get the goodwill. So this is that means all about the just I gave the explanation of the three methods. Clear? After that, that means I will explain in details about that means each and every methods, different questions I will solve. Clear? So by that time also I will explain in detail about the different treatment, about the abnormal profit or abnormal loss. I will explain it. But remember one thing, whenever you will solve this, that means questions under that means average profit method or super profit method or capitalization method, you have to go through the detail of the content of the questions. What are the information it is given and how you will solve it. And you see now under the capitalization method, here it is given capitalization of average profit and capitalization of super profit. So under which concept, that means you are asked to calculate the goodwill. That first of all you will see. Clear? That means so in the next video I will explain you about the different that means different methods, numerical questions I will solve it.